students, now we will learn about adjusting entries. In this topic, we will learn about the nature of the adjusting process, the adjusting entries for accruals, and the adjusting entries for deferrals, and also the adjusting entries for depreciation. So let's start. In our last video, the November and December transactions for net solutions were recorded using the double entry accounting system. After the transactions were recorded, an unadjusted trial balance was prepared on December 1st, verifying that the total debit balances equal the total credit balances. Before financial statements can be prepared, however, some accounts in the unadjusted trial balance must be adjusted. These adjustments are necessary because the transactions for net solutions were recorded using the accrual basis of accounting. Accrual and cash basis of accounting. Under the accrual basis of accounting, revenues and their related expenses are reported on the income statement in the period in which a service has been performed or a product has been delivered. Cash may or may not be received from customers during this period. For example, a cleaning company will record revenue after it cleans an office building, even if it is not paid for several weeks. The accrual basis of accounting also requires expenses to be recorded when they are incurred, not necessarily when cash is paid. Some companies use cash basis of accounting, but some others use accrual basis of accounting. Under the cash basis of accounting, revenues and expenses are reported on the income statement in the period in which cash is received or paid. For example, fees are recorded when cash is received from clients. Likewise, wages are recorded when cash is paid to employees. The net income or net loss is the difference between the cash receipt of revenues and the cash payments of expenses. Revenue and expense recognition. To be useful for decision making, financial statements must be provided on a periodic basis. As a result, the economic life of a business is divided into time periods such as a month, quarter of a year, or full year. Under accrual accounting, the net income of a period is reported using revenue and expense recognition principles. Under the revenue recognition principle, revenues are recorded when services have been performed or products have been delivered to customers. Revenue is measured as the value of the assets received, such as cash or accounts receivable. The process of recognizing revenues is called revenue recognition. Under the expense recognition principle, the expenses incurred in generating revenue must be reported in the same period as the related revenue. This is also called the matching principle. By matching revenues and expenses, net income or loss for the period is properly reported on the income statement. Adjusting entries are required to properly match revenues and expenses. There are some accounts on the unadjusted trial balance, however, require adjustments for the following reasons. Some revenues and expenses might be unrecorded at the end of the accounting period. For example, a company may have provided services to customers that it has not billed or recorded at the end of the accounting period. Likewise, a company may not pay its employees until the next accounting period, even though the employees have earned their wages in the current period. Second, some expenses are not recorded daily. For example, the daily use of supplies would require many entries with small amounts. Also, information about the amount of supplies on hand on a day-to-day basis is normally not needed. Third, some revenues and expenses are incurred as time passes rather than as separate transactions. For example, rent received in advance or unearned rent expires and becomes revenue with the passage of time. Likewise, prepaid insurance expires and becomes an expense with the passage of time. Here are some important notes in adjusting entries. The analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. The journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. All adjusting entries affect at least one income statement account and one balance sheet account. Thus, an adjusting entry will always involve a revenue or an expense account and an asset or a liability account. The two general classifications of accounts requiring adjustments are accruals and deferrals. An accrual occurs when revenue has been earned or an expense has been incurred, but has not been recorded. If the accrual is for revenue, the adjusting entry debits an assets or account receivable and credits a revenue account. If the accrual is for an expense, the adjusting entry debits an expense account and credits a related liability account such as accounts payable or wages payable. Deferrals. A deferral occurs when cash related to a future revenue or expense has been initially recorded as a liability or an asset. If the cash received is related to future revenue, it is initially recorded as a liability called unearned revenue. The adjusting entry in the period when the revenue is earned debits an unearned revenue account and credits a revenue account. If the cash paid is related to a future expense, it is initially recorded as an asset called prepaid expense. The adjusting entry in the period when the expense is incurred debits an expense account and credits a prepaid expense or asset account. So here are the adjusting entries for accrued revenues and accrued expense in the end of period. And here you can see the adjusting entries for deferrals, that is unearned revenue, and prepaid expense for the end of period. So now let's do practice the adjusting entries. The first is for accrued revenues. During an accounting period, some revenues are recorded only when cash is received. Thus, at the end of an accounting period, there may be revenue that has been earned but has not been recorded. In such cases, the revenue is recorded by increasing, debiting an asset account, accounts receivable, and increasing or crediting a revenue account or fees earned. Assume that the net solution signed an agreement with Downer Co. on December 15. The agreement provided that Note Solution will answer computer questions and render assistance to Downer Co.'s employees. The service will be billed to Downer Co. on the 15th of each month at a rate of $20 per hour. As of December 31st, NetSolution had provided 25 hours of assistance to Downer Co. The revenue of $500 will be billed on January 15. However, NetSolution earned the revenue in December. The claim against the customer for payment of the $500 is an account receivable or an asset. Thus, the account receivable account is increased or debited by $500, and the fees earned account is increased or credited by $500. The adjusting journal entry and the accounts are as follows. If the adjustment for the accrued revenue, $500, is not recorded, fees earned and the net income will be understated by $500 on the income statement. On the balance sheet, asset or account receivable and owner's equity, Chris Clark Capital, will be understated by $500. The effects of omitting this adjusting entry are as follows in this picture. Next is about accrued expenses. Some types of services used in earning revenues are paid for after the service has been performed. For example, wages expense is incurred hour by hour, but is paid only daily, weekly, bi-weekly, or monthly. At the end of the accounting period, the amount of such accrued but unpaid items is an expense and a liability. For example, if the last day of the employee's pay period is not the last day of the accounting period, an accrued expense or wages expense and the related liability or wages payable must be recorded by an adjusting entry. This adjusting entry is necessary so that expenses are properly matched to the period in which they were incurred in earning revenue. In this illustration, NetSolution pays its employees bi-weekly. During December, NetSolutions paid wages of $950 on December 13 and $1,200 on December 27. These payments covered pay period endings on those days. As of December 31st, NetSolutions owes $250 of wages to employees for Monday and Tuesday, December 30 and 31st. Thus, the wages expense account is increased or debited by $250, and the wages payable account is increased or credited by $250. The adjusting journal entry and T accounts are as follows. After the adjusting entry is recorded and posted, the debit balance of the wages expense account is $4,525. This balance is the wages expense for 2 months, November and December. The credit balance of $250 in wages payable is the liability for wages owed on December 31st. Net Solutions paid wages of $1,275 on January 10. This payment includes $250 of accrued wages recorded on December 31st. Thus, on January 10, the wages payable account is decreased or debited by $250. Also, the wages expense account is increased or debited by $1,025, which is the wages expense for January 1 until 10. Finally, the cash account is decreased or credited by $1,275. The journal entry for the payment of wages on January 10 as shown in this picture. If the adjustment for wages $250 is not recorded, wages expense will be understated by $250 and the net income will be overstated by $250 on the income statement. On the balance sheet, liabilities or wages payable will be understated by $250 and owner's equity or critical capital will be overstated by $250. The effects of omitting this adjusting entry are as shown in this picture. The next is adjusting entries for deferral. The first is about unearned revenues. The December 31st unadjusted trial balance of net solutions indicates a balance in the unearned rent account of $360. This balance represents the receipt of 3 months' rent on December 1st for December, January, and February. At the end of December, 1 month rent has been earned. Thus, the unearned rent account is decreased or debited by $120, and the rent revenue account is increased or credited by $120. The $120 represents the rental revenue for 1 month. The adjusting journal entry and the accounts are as follows in this picture. After the adjusting entry is recorded and posted, the unearned rent account has a credit balance of $240. This balance is a liability that will become revenue in a future period. Rent revenue has a balance of $120, which is revenue earned during the current period. If the preceding adjustment of unearned rent and rent revenue is not recorded, the financial statements prepared on December 31st will be misstated. On the income statement, rent revenue and the net income will be understated by $120. On the balance sheet, liabilities or unearned rent will be overstated by $120, and owner's equity or critical capital will be understated by $120. The effects of omitting this adjusting entry are as follows. The next is prepaid expenses. The December 31st, 2018 unadjusted trial balance of net solutions indicates a balance in the surplus account of $2,000. In addition, the prepaid insurance account has a balance of $2,400. Each of these accounts requires an adjusting entries. Surplus. The balance in net solution surplus account on December 31st is $2,000. Some of the surplus, such as paper and envelopes, were used during December and some are still on hand or not used. If either amount is known, the other can be determined. It is normally easier to determine the cost of the surplus on hand at the end of the month than to record surplus used on a daily basis. Assuming that on December 31st the amount of surplus on hand is $760, the amount to be transferred from this asset account to the expense account is $1,240 computed. At the end of December, the surplus expense account is increased or debited for $1,240 and the surplus account is decreased or credited to record the surplus used during December. The adjusting journal entry and the accounts for surplus and surplus expense are as follows. Prepaid insurance. The debit balance of $2,400 in Net Solutions prepaid insurance account represents a December 1st prepayment of insurance for 12 months. At the end of December, the insurance expense account is increased or debited and the prepaid insurance account is decreased or credited by $200. The insurance for 1 month. The adjusting journal entry and the accounts for prepaid insurance and insurance expense are as follows. After the adjusting entry is recorded and posted, the prepaid insurance account has a debit balance of $2,200. This balance is an asset that will become an expense in future periods. The insurance expense account has a debit balance of $200, which is an expense of the current period. If the preceding adjustment for supplies and insurance are not recorded, the financial statements prepared as of December 31st will be misstated. On the income statement, supplies expense and insurance expense will be understated by a total of $1,440, and net income will be overstated by $1,440. On the balance sheet, supplies and prepaid insurance will be overstated by a total of $1,440. Because net income increases owner's equity, Chris Clark Capital will also be overstated by $1,440 on the balance sheet. The effects of omitting these adjusting entries on the income statement and balance sheet are as follows. The last of adjusting entries is adjusting entries for depreciation. As we know, fixed asset or planned asset are physical resources that are owned and used by a business and are permanent or have a long life. Examples of fixed assets such as land, buildings, and equipment. In a sense, fixed assets are a type of long-term prepaid expense. However, because of their normally high amount and long life, they are discussed separately from other prepaid expenses. Fixed assets, such as office equipment, are used to generate revenue, much like supplies are used to generate revenue. Unlike supplies, however, there is no visible reduction in the quantity of the equipment. Instead, as time passes, the equipment loses its ability to provide useful services. This decrease in usefulness is called depreciation. All fixed assets, except land, lose their usefulness and thus are said to depreciate. As a fixed asset depreciates, a portion of its cost should be recorded as an expense. This periodic expense is called depreciation expense. The adjusting entry to record depreciation expense is similar to the adjusting entries for supplies used. The depreciation expense account is increased or debited for the amount of depreciation. However, the fixed asset account is not decreased or credited. This is because both the original cost of a fixed asset and the depreciation recorded since its purchase are reported on the balance sheet. Instead, an account entitled Accumulated Depreciation is increased or credited. Accumulated depreciation accounts are called contra accounts or contra asset accounts. This is because accumulated depreciation accounts are deducted from their related fixed accounts. This is because accumulated depreciation accounts are deducted from their related fixed asset accounts on the balance sheet. The normal balance of a contra account is opposite the account from which it is deducted. Because the normal balance of a fixed asset account is a debit, the normal balance of an accumulated depreciation account is a credit. The normal titles for fixed asset accounts and their related contra asset accounts are as follows. December 31st, 2018, unadjusted trial balance of net solution indicates that net solutions own two fixed assets, land and office equipment. Land does not depreciate and therefore does not have a contra account or an adjusting entry. Office equipment, however, does depreciate and requires an adjusting entry. Assume that the office equipment depreciates $50 during December. The depreciation expense account is increased or debited by $50, and the contra account or accumulated depreciation of office equipment is increased or credited by $50. This is the adjusting journal entry and the accounts for the depreciation. After the adjusting journal entry is recorded and posted, the office equipment account still has a debit balance of $1,800. This is the original cost of the office equipment that was purchased on December 4. The accumulated depreciation office equipment account has a credit balance of $50. The difference between these two balances is the cost of the office equipment that has not yet been depreciated. This amount, called the book value of the asset or net book value, is computed as follows: book value of assets equal to cost of assets minus with cumulative depreciation of asset. Thus, the book value of net solutions office equipment at the end of December is $1,750. The office equipment and its related cumulative depreciation are reported on the December 31st, 2018 balance as office equipment $1,800, accumulated depreciation $50. If the adjustment for depreciation $50 is not recorded, depreciation expense on the income statement will be understated by $50 and the net income will be overstated by $50. On the balance sheet, assets, the book value of office equipment and owner's equity, Chris Clark Capital, will be overstated by $50. Here are the effects of omitting the adjustment for depreciation. Okay, students, this is all about the adjusting entries. Please do exercise and read all of the sources that you can gather about the adjusting entries. Bye!